Welcome back, everybody. We're going to get started with our lunchtime keynote speaker. And at this time, I would like to welcome our keynote speaker. He's going to talk about how the petroleum industry resets, perspectives on the road ahead. We're going to hear from Mr. Stephen Trammel. He's a research director and advisor at IHS. And just a word or two about him. I'd like you to know who your speaker is. Mr. Trammel is the director of the North America Well and Production Content for IHS Energy. Mr. Trammel is an expert on U.S. current oil and gas activity with a special focus on unconventional resources. And also Mr. Trammel is a participant in the Expert Source Program for IHS, which delivers strategic thought leadership to the oil and gas industry through insight and analysis. And he has spent the majority of his career with IHS and its predecessors, having joined the company back in 1981. I believe there was an oil bust.
Just gave my age away.
I believe there was an oil bust back then too, and we're looking at one now. So Mr. Trammel is a regular speaker and writer on a variety of industry topics, having begun his oil and gas industry career as a writer covering Rocky Mountain activity for Petroleum Information, which is now IHS. So with that, please give a warm welcome to Mr. Trammel.
Thank you, Kirby. Thanks very much, everybody. I appreciate it, and thanks to Colorado Mesa University and Garfield County for putting on just a fantastic event. Lots of issues around oil and gas and energy development. It's incredibly important to Colorado. And as everybody knows, because you've been benefiting from low energy prices, we're in a real downturn right now. And we're not going to spend any time really talking about the road of how we got here, because it's essentially economics 101, supply and demand. And the oil and gas industry is frankly a victim of its own success. We just did too much great work in science and completely turned the world upside down from an energy perspective. So congratulations and kudos to everybody that made that happen. But now we're sort of weathering a big storm of oversupply. So that's really what we're going to talk about. I want to thank my co-author, Dr. Pete Stark. Some of you may know Pete. He's been around even longer than I have, and just a great friend and mentor. So we put this together with an oil component and a gas component, but both of those things are really coupled together now. And as we get into this, you'll see why I say that. Now, we have an old saying in the Rocky Mountains: only fools or newcomers try to predict the weather. Well, you could say the same thing about predicting oil prices, and you can tell by this blonde mustache in Kirby's intro that I am not a newcomer. So with that foolish caveat, let's go right ahead and dive in here. So we're calling this the Great Energy Shakeout, really, and it comes from supply and demand. But just to summarize it overall, 2016 has been a year of survival and opportunity. In some cases not survival, with bankruptcies and so forth. Oil, gas, and coal energies have all faced low prices, overcapacity, economic growth, policy uncertainties, and we talked a lot about that today already and yesterday too, and volatility are really at record levels. So cost and technology is really changing at unprecedented speed. That's what really launched this unconventional tight oil and shale gas revolution. I couldn't think of a better metaphor, and I certainly didn't come up with this myself, than a roller coaster for the oil and gas business. And I've ridden that roller coaster since 1981. We had a real serious dip in '86, again in the '90s, and so forth. So this picture was the most complex roller coaster I could find, and it looks like it might be pretty fun to ride if you survived it. But it is a great metaphor for this business, and the ups and downs are going to be with us, just like with any other commodity price that's happening. So with the advent of this U.S. unconventional revolution, and it certainly happened in Canada as well, the reactivity of supply to prices was really has turned into a three three-tiered or three-component kind of formula. Number one, new strategies by very low-cost oil producers in the Middle East, and that primarily Saudi Arabia. They saw what was happening in the U.S. They saw us really becoming a dominant player again in the energy world, all the way from production of oil and gas to chemical plants and things coming back here. So they got very concerned about losing market share, and our import needs have plummeted dramatically. But again, I'm not going to focus too much on history, but they kind of forced the issue, as we all know, in 2014. U.S. shales can really respond very quickly, and look how fast we ramped up with this revolution, and now we're finally starting to slow down. So we reacted, but we didn't slow down very quickly to rebalance supply, and I'm going to talk about why that is in just a moment. And then lastly, the rest of the world is a very low reactivity environment. They can't move nearly as fast as we can. We have private land that's being used, and we can scale up and scale down really fast compared to the rest of the world. So let's look at some key messages for the global oil market, and we're really eyeing a move from a glut of supply to finally a balance, and I think it's going to be the third quarter of this year where we're going to start to see that rebalance happen. Don't anticipate this being real dramatic for probably a couple of years, but it is going to start to turn around. And we've had some what I call false rallies in price. We dipped way low in January, then we've been climbing up. I want you all to know that the market trading in crude oil is 15 times larger than the actual physical market of selling and buying crude oil. So any little twitch makes that market react. And as a recent example, there's a strike in Kuwait that just started with oil field workers. We don't think it's going to be very long-lived at all, but it had helped to bump prices up. Just the fact that they met last Sunday and talked about freezing production levels made that twitch again. And then we'll talk about what did not happen at that too in just a moment. So anyway, continued production declines are really critical to rebalance the market, and we're finally getting there. And I'll talk about why it's been slow, as I said. So we think that Brent average, which is kind of the global average, and WTI, our U.S. benchmark crude price, is gotten really close to Brent now. But we're looking at about a $41 a barrel average when we get to the end of 2016, and climbing up to almost 50 by 2017. Now, anecdotally, I've talked to a lot of operators, and they say, well, we want it to get to 60, and then we'll have some more certainty, and then we'll really start investing again. But I'm going to show you some break-even prices here in a minute that $40 and $50 oil can work if you're in the right spot. So there's physical barrels of oil and higher priced oil barrels like we have in the U.S. because of all the technologies that's involved to drill horizontally and frack and so forth. And then there are political barrels. And so by political barrels, I'm throwing Saudi Arabia in there, and certainly Iran is what I would characterize as the chief example of political barrels. And with the sanctions lifting, Iran is going to start being able to sell crude oil on the market again. It could ramp up, and we'll look at some numbers here in a moment. We don't think it's going to be much more than 400,000 barrels a day coming into the market initially. And actually the market has already factored in that kind of input there. So the impact of any agreement by oil producers to freeze, as I say, created kind of a twitch, but they met Sunday. And we sort of predicted this, not to say we're geniuses, because most everybody else was like, this is not going to really happen, more than likely. And it did not happen. Nobody could come to an agreement. The Saudis and the Iranians are still kind of at each other, really, and big competitors in many ways, from religion to crude oil. And so the freeze in production just did not happen. Now, the other side of this coin, of course, is demand. So we're talking about oversupply, but demand has been lagging. And we're going to look at global economies just in a moment. But there is a strength in the U.S. There's a China gasoline consumption, and now India is playing into gasoline consumption. And even though it's a refined product, that is certainly helping adjust the supply and demand imbalance that we've seen in crude oil. So global liquids, our demand is going to rise about 1.2 million barrels a day in 2016. That's 1.2 million barrels a day. That's a lot of oil per day times 365 days. So we're going to talk about how thin the OPEC spare capacity is. And even though we're in dark times right now, this presentation is going to be riddled with bright spots. And some of them are way down at the end of a tunnel. And it's not the train. It truly is a blind spot, or a bright spot. But I'm going to try to point out some of the positives that's happening in the business right now, too. So here's really just a snapshot of oil fundamentals and prices for you. You can see world economic growth has just been kind of sluggish overall. These are growth from the previous year, so 3.1% in 2017 is pretty positive. If you look at that next line down where you've got world oil and liquids demand growth, you can see that we really dipped hard in 2014. That's what started this whole thing, along with a bunch of barrels of oil coming back from Libya and that poor war-torn country. We're going to talk about outages here in a moment too. But you can see we really dipped down, and then demand climbed back up in 2015, sort of has leveled out. But if we look at many years average of demand growth, we're right in that average range now. So that's really a bright spot. And there's other information on here. You guys are going to get access to this presentation on a website that Kirby's putting together. So I've got a lot of text-heavy slides in here, but I did that by design, even though it breaks all PowerPoint rules, so that you would have a reference that you could refer back to. So again, we talked about our Brent averages, $41 this year, $49 next year. Regional economic growth outlook. So you can see North America, we're hobbling along about 2.3%. And the U.S. is an interesting example of what we're calling a two-tiered economy. And you see that around the world, too. Manufacturing in the U.S. is really hurting right now. Services and information services and things like that are growing pretty strongly. So we've got these two parts of our economy that aren't really matching up with each other. But nevertheless, we're doing okay, climbing up to maybe almost 3% growth as we get into 2017. And here's just some key points on here. Calmer financial markets right now have reinforced the outlook for a sustained, though subpar over time, global growth in 2016. And it really reinforces the feeling among financial analysts that we're not headed for some big worldwide recession or anything like that. Europe's finally starting to do some recovery, and even Greece, for example. So this financial volatility that we see globally certainly could return at any time. There's all kinds of tensions and issues in the world that we all know and worry about. But the fundamental drivers around the world are still in place. Upward pressures on headline inflation would likely be small, and this year certainly. Most commodities, and not just oil and gas, are facing a market that's still characterized by oversupply, and that's in many, many commodity areas. Now that's diminishing, and that's why we think any big increases in price, again, there might be a false rally, but any big increases in price are not going to happen in the next couple of years. Negative interest rates in the developed world, are helping to ease pressures on emerging market countries. So those emerging market countries that are trying to grow and modernize and so forth are actually being helped along now with low interest rates in the development world, in the developed world, for investment reasons. And so financial markets overall are much less pessimistic than they were since mid-February. We all remember what the stock market was doing in January, and the closer you get to retirement, the more you worry about your 401k. So I'm back to Dr. Wolk's relax thing here for that right now. Hopefully you are too. So certainly demand supply growing faster than demand certainly set the stage, as we said. Markets really finally began to tighten, and here we are, right? U.S., Canada, and Brazil have accounted for virtually all the non-OPEC growth that we've seen over the last few years. And the rest of non-OPEC around the world has not been able to increase overall net production. This is all leading toward what we're going to need in the future, which is a big bright spot if you're an E&P company. Reduced maintenance and project delays are going to further impact non-OPEC, and we finally started to slow down ourselves. So OPEC spare capacity. Remember we said 1.2 million barrels a day in demand growth is happening. We only have about 2% of the world oil market it could be covered by OPEC right now, and that could potentially become a serious issue as that demand happens. I don't think anybody is hoping for 140 oil. No doubt there are some people. I shouldn't say that. Yeah, and I can think of those company names now that I give it a second thought. But we could see those price spikes again, and we're back to that old complex roller coaster that we've been riding. So keep buying those tickets and don't overeat before you get on the roller coaster. Global production outages still remain high. So this is a negative, but it's also a bright spot. And, historically high, 3.5 million barrels a day in outages. And so now Libya is back to an outage. They triggered the whole price collapse, but now they're back to an outage. We talked about Iran already. They could come in with 750,000 barrels a day. We think it's going to be closer to 400,000. Other countries in OPEC, like Nigeria and the neutral zone countries, and as well as some non-OPEC, have another 1.5 million barrels offline right now. We don't see much of a likelihood of these countries bringing that oil back online, with the exception of Iran. But in every prediction we make, we have ... but in it. Okay, so that's our flexibility there. Here's U.S. Oil production. Declines are expected to continue again for the next few months. We need to get down to about 8.5 million barrels a day of U.S. production, down from a high approaching 10 in the high 9.6 or whatever range. So we're finally starting to see that rollover in U.S. production, and we're going to creep back up to 9 as we get into 17. But again, that's going to help rebalance things in the third quarter, that U.S. production has finally fallen off enough. We talked about this in the intro, that we can respond so incredibly fast here, weeks or months, not years. The wide range of well productivity variability has allowed us to really high grade where people are drilling, and has had the actual negative effect of not having production decline fast enough to rebalance. People were focusing on the sweet spots, and these unconventional rocks especially, there's huge variability in there, just like the ancient ocean. There are richer parts of the ocean and less rich parts, and you want to be in those sweet spots definitely in this day and age. And then there's been a lot of cost cutting by service companies and E&P companies, and that has certainly kept production going probably longer than it needed to help us rebalance. Productivity productivity improvements are still occurring. We're going to look at the Niobrara here just in a second as an example of that. And company positions vary as much as the rocks vary. Some people are in the sweet spots, a lot of people are not. Those people are the ones that are really struggling right now. So capital efficiency gains is a big one, and on the right side there you can see cumulative U.S. onshore cost reductions. And so some of the service companies have been approaching 40% cost reductions. They're going to want to recover that as things come back, of course. But that's, again, help things keep going. And then look at that chart on the left. That red line is the rig count. You would think, wow, look how steep of a drop-off in oil rigs that is. But then look at what happened to production. It's going the opposite direction. So it's just been amazing what's happened. 6 million barrels a day in January 2011, 9.6 million barrels a day in the spring of 2015. It just didn't decline things as we thought, again, because we had these declines in cost. And so overall, operators have a 65% improvement in capital efficiency. And by that I mean for every dollar that you invest to produce a barrel of oil, it's carrying you 65% further now than it did before this. So again, the industry has done an incredible job. Painfully, it's in many cases, of course, when you talk about people and so forth, but an incredible job in making that capital go further. We're finally seeing the decrease, as I've said, and the deepwater production was increasing, which didn't help for oversupply, and it's going to grow, but much more slowly, because those offshore deepwater wells are, you know, billions of dollars, and with prices where they are, people are just going to hold off on those projects, certainly. So here's the example of the Niobrara play, and we've got some colorful names here for these quintiles. So we took the production of wells in a play and we sliced it into 20% slices. So the top best 20% wells are the hogs. The next one down are the large, medium, small, and then the poorest wells are the dogs, which pains me to say because I'm a real dog lover, but it's a colorful way to say it, I suppose. So where you see that red and orange are where the sweet spots are, and you can see how variable this can be just over the Niobrara play in the DJ Basin. So the people that are still drilling are in those sweet spots, and break-evens can jump from $20, $30, $40 a barrel in the sweet spot to $150 a barrel break-even if you're not in the sweet spot. So it makes a huge difference financially. We talked about overall U.S. wells are still seeing productivity gains. The Niobrara is certainly another example of that, and you can see that average line. It's not a big spike up, but it's a steady improvement in productivity over time as operators really figure out the rocks and what the best completion practices are and so forth. This did not come from the Bible, although it sounds like it may have. Explore not, discover not. We have the lowest number of conventional oil and gas discoveries since my birth year, 1952. That is disturbing. Now, it's also a bright spot, right? If you're in the E&P business, but we're just seeing these huge fall-offs in discovery. So what is going to happen here? We don't think people are going to catch shale fever as hard as they did. There's a lot of lessons being learned in this great shakeout. Many tight conventional plays compare very well with the leading shale plays. So what's happening around the country, and what this slide represents, is people are going back into the old, mature, producing conventional areas. They're going to the more marginal parts of those old plays. Think of it maybe as a halo on the outside of the best part of the conventional play, and they're applying the technology we learned in unconventional revolution with horizontal drilling. A lot of times you don't even have to frack it. You can just drill it horizontally, or you can do a low frack because these rocks are not as tight as a true conventional. But you can see throughout the Rockies, and that's what the star and the arrows represent, is we have some really nice opportunities for people to go back in. And the reason this works is, number one, the sweet spots in the unconventional plays that are so good are very tightly held. So it's hard for you to get in there. So that's number one. Number two, you go to an area that has had conventional drilling. You have vertical wells that you can re-enter and drill horizontally. You've got infrastructure in place. You have a public who is used to having oil and gas in their area for 50 years. And so you don't get a lot of pushback and so forth. So there's so many benefits in North America for having this. We just completed a study on this, actually, and there's some real sleeper plays out there and some real testing going on of horizontal drilling. And we're seeing improvements, say the Sussex and the Shannon and the Powder River. Those wells might produce 20 barrels a day from a vertical well. They're getting them up to 800, 900, 1,200 on an initial potential just by drilling them horizontally. So that's part of the scope of what I'm talking about and why we think this is going to be very big going forward. Now here's some break-even stuff. 64% of new U.S. onshore production breaks even at less than or equal to $50 a barrel. Remember, we said we're going to average about 50 next year. So that also includes a 10% profit. So it's not just a pure break-even, you know, no profit. It includes a 10% profit. And when you look at the details here in the bullet points, that middle bullet point, there's our 65% at less than or equal to 50. But there's almost half of the onshore production that breaks even at equal to or less than $40 a barrel. So people can still make money if you figure out how to control your costs, and those are good percentages. I think this is a real another bright spot that we have here. Here's our benchmark crude outlook going out to the fourth quarter of 2017. So it just shows finally the fall off in production and what's happened with prices. Let's talk a little bit about our assumptions on this forecast to get to almost 50 by 2017. Oil prices remain low enough to keep pushing U.S. crude production lower and, again, rebalancing supply. There are no coordinated production cuts by governments of OPEC or non-OPECs in the near term, and global liquids demand is going to maintain that 1.2 million barrels a day. Price outlook risks: on the upside, non-OPEC, non-U.S. crude production falls more rapidly than expected, and big projects internationally get canceled or postponed or whatever. That's the upside. The downside is those political barrels. So Iran could come in, Libya might get back in the mix again, and maybe those come in more than we anticipate, and U.S. crude production doesn't fall quite as fast as we think it will by the third quarter. So that's our risk assessment there. This is an overview of where that 1.2 million barrels a day is. So you can see some demand growth in North America. Europe is finally crawling back up in 2017. Eurasia, Middle East drops off a bit, but then China, Asia, and so forth, a lot of growth there in demand, as we talked about earlier, especially with gasoline demand. So refilling the hopper, roughly 40 million barrels a day of new crude production are going to be needed by 2030 to offset declines and meet demand over that time frame. Now it says roughly 40 million. We've actually started to decline that maybe 20 million a day. So think of the 40 million as crude and liquids. But think of the 20 million projection as renewables probably coming in that time frame, maybe a little bit stronger. So that's going to affect. And Mr. Harris from Exxon is going to, if his plane gets here in time, is going to let us know what their longer term outlook is after I'm finished up here. So the key thing to remember here, and I put it in bold underscore, this price collapse is by no means permanent. We're going to be back on the roller coaster for sure, and certainly future barrels around the world are going to be more expensive to find and produce. It could be as much as $100 a barrel is going to be needed to hit those levels of supply growth that are going to be needed over that time frame. Let's switch gears to natural gas now. As I say, we divided this up just to give you a view of it, and certainly this is very important to Colorado and western Colorado and the Piceance Basin specifically. But we talk about weathering excess supplies, and it really is about the weather, actually. So U.S. gas producers, and certainly in the Rockies, have got to find new markets to absorb supplies, and we're talking LNG there. We had the Oregon LNG plant just got postponed perhaps, or even killed, I don't know, and I missed that talk yesterday, so I'm not sure if he gave you a good update on that or not, but that would have been quite an outlook for Rockies gas producers. One thing that if you think outside the box for this, and I know this is going to sound pretty bizarre to you, but what about the oil and gas business teaming up with environmentalists? I'm pausing there. Let me say that again. Teaming up with environmentalists. There are 4 dams on the Snake River, and those dams produce some hydroelectric, but very little irrigation for farmers and ranchers. We destroyed the greatest salmon and steelhead runs in the world, and by the way, folks, that's nice protein we can all eat. We destroyed that over time with dams and so forth. So if we team up with the environmentalists, we'll remove those dams, we'll send Rockies gas out there to Oregon and turn those power generating turbines, and then we get our salmon and our steelhead back. It sounds like a win-win. Now, you know, some people may be skeptical of that, but we've got to be really creative for the Rockies producers, and I'll talk about the Northeast Marcellus and Utica in just a second and what kind of pressure that puts on the Rockies. Multiple factors indicate that oversupply in gas, it's even worse than oil, if you can imagine that, and it's going to persist for quite some time. We'll look at projections there. For U.S. gas storage levels, and that's kind of been a benchmark measurement that drives Henry Hub prices over time. So high gas production, along with a milder than normal winter, really induce very low winter-to-date storage withdrawals. In fact, they started injecting gas back into storage as early as March 11th. Now the weather helped a bit because it did get colder. We thought we were going to have 874 BCF more than the 5-year average as we went into the summer season, where you're going to refill that hopper for the next winter's heating. But now it looks like that 875 may drop to 821. That's still very, very robust, but just in the last 2 weeks we've had some more withdrawals happening because the weather did cool off. So a gas operator is going to feel like a farmer being so dependent upon the weather, and that's just going to be a fact of life. Now this next point is a little counterintuitive. At current low gas prices, there is little switching from coal to gas, which has been a big thing that's happening over the last few years to generate power. There's just not enough capital being generated with the gas. All the easy plant conversions have been done. So the rest of the coal-fired plants that could be converted are going to be tougher and require more capital. So that's why that's really slowed that down. And prices really become a hammer rather than a scalpel for market rebalancing. I mean, the price is just saying you've got to stop producing so much gas. Okay, if the injections the rest of this year, which is about to end, were to equal the 5-year average rates for the rest of the summer refill season, which goes from May through October, those end October inventories could be 4,700 TCF BCF of gas, and we think that high inventory level surplus in April is going to result in some below average injection rates through May, October, as people finally are hammered into cutting back on production. So we expect the end October inventory to maybe reach 4,000 BCF. That would still be a record amount of gas in storage entering the winter. So gas producers are hurt. And Do we have 2 slides there? These are just some graphics, and you can see these in your handbook. So up on the upper left is that gas storage, and you can see the red line is, you can see we're above that 5-year average for storage and injection and so forth. The production outlook there on the upper right, you can see we had a January outlook, and now we've reduced it just a little bit in February. Not enough to make a huge difference, but at least it is coming down just a little bit. And then at the very bottom there, Henry Hub prices, history and outlook. And if you look at it closely, you can see as far out as 2020, 2021, we're trying to get to $4 gas. And so that's years out in the future. North American gas has really reloaded and reconnected. It was certainly global demand hit. We had the unconventional revolution. You know, oil was a big driver of gas production too, and oil production from unconventional reservoirs has had an unintended consequence on gas supplies, and we're going to go into that in just a second. Porting shale technology from gas to oil. So we took what we learned about unconventional shale gas, and we went back into what we call tight oil. And the reason we call it tight oil is it's not all just shale. It's shales, it's tight carbonates, tight sandstones, a whole mix of inner beds that people are drilling now for tight oil. But the best plays, like the Eagle Ford, for example, have a lot of associated gas with it. So you remember our chart earlier of oil rigs falling off and the red line, and then the oil production in green was still going up? Even more dramatic in gas. That rig count for gas just dropped almost off the table, but yet gas production has continued to climb and improve. That's because when you're drilling an unconventional tight oil reservoir, it's a lot more difficult to move that oil molecule through the tight rock than it is to move a gas molecule. So you will see people in the Eagle Ford drilling 80% oil, not 100% oil zones, because they want that gas to push that oil and help be a reservoir drive mechanism. Now, it's resulted in this dramatic growth of associated gas. And here's just a quick snapshot. You can see associated gas there at the bottom of the chart and the growth there, and then some of the other dry gas zones and the Marcellus and the Utica, which we're going to get to in just a moment. So dry gas production outlook is certainly going to be dependent on associated gas. As oil prices come back and gas prices languish, people are going to continue to produce a lot of associated gas, but in many cases it's almost free, and I'll show you a chart on that just in a second. Here's productivity gains. We're, in the interest of time, we're going to kind of skip over this one, but just building a lot of gas reserves and resources, and these are Potential Gas Committee, IHS projections, and so forth kind of combined there. Now here's the break even on gas. More than 1,400 TCF of gas resource has a Henry Hub break-even price of $4 per million BTU or less. Now we're way below that right now, I realize, but if you look at the chart on the left-hand side, you see the Bakken has a break-even for gas of more than $8 minus. So when I talk about a free revenue stream for this associated gas, your oil is paying for the well. The gas is just an extra stream that you get. So you've got great production and economics there. But then as you start to climb up and you see the Granite Wash in the Anadarko Basin, it's under $2. That's because there's a lot of liquids there to support that price. The Utica is under $3, Haynesville's under $3, Marcellus is right around $3, and then you start to get into the other plays further out to the west, and you've got the Horn River up in British Columbia has a break-even of something more than $7. So again, a lot of variability there, but 800 TCF of gas breaks even at $3, and then, as we said, 1,400 TCF at $4. Appalachia is where gas is right now. It certainly hurt the Rockies, as I said. The mighty Marcellus is that big blue wedge there of growth and productive capacity outlook. The Utica is now coming on strong, right in the same neighborhood, and those two plays are right where most of the people in the United States live. So that's your biggest market. Rockies gas producers got quite a bit of relief when the Rockies Express pipeline got finished and went back to the Midwest. Well, now we're being pushed out. So I'm back to my fishy story again. Just keep thinking about that one, right? This is the Marcellus and Utica growth. You remember we talked about the Niobrara continuing to have better and more productive wells. Well, here's the same thing. And the illustration here is the dark blue line. We predicted production about 37 BCF a day. That's phenomenal gas production from one play. We used to think the Barnett was great at 5, for example. So there's the Marcellus. And then the very next month in October, look at that gray line where we revised that production up. And you see a very similar thing on the right-hand side in the Utica. So just like the Niobrara, just like the unconventional zones, lots of sweet spot variability. If you look at the Marcellus on the right, you can see a real concentration of best wells in northeast Pennsylvania and also in southwest Pennsylvania down in the Washington County area, and then some marginal wells in between there. On the left-hand side, the Utica has some really good wells, but really scattered, and that just reflects the youth of that play and people still trying to figure it out. Eagle Ford and Permian plays, and we talk about the Permian, which is a whole collection of things, of different zones that are producing right now. We've also revised their productive forecast up a little bit in September, but then really growing again in the October. Now in the Permian, we're seeing some capacity fall off for gas there as people focus more on just the pure oil. Low gas prices are going to keep people from drilling in the most gassy plays. They're really going to focus on oil plays with associated gas. First year decline rates in the Marcellus, they were 75–80% at one point. They got them down to an average of 65%, but they've brought down that decline rate to 57% even recently. So a lot of recent well performance improvements are backing up these decline rates. And rig counts in the Eagle Ford and Permian, which are very key contributors of this associated gas, are going to start rebounding now as oil rebalances. Where is the market other than salmon for gas? It's in the power segment still, but we need to get gas prices up enough to where they can compete more with coal. And I realize there's coal folks in the room, and it's just going to be a battle. Unfortunately, gas is a very clean burning fuel, and it's going to be tough to compete. You see a tiny little blue sliver right above the green, and that's transportation. I often get asked about that, and we just haven't scaled up enough for that in the U.S. LNG, the once and future wild card, you'll see this in your handout, so let's just jump to the longer view. Sum it up, LNG is suffering from oversupply, weak demand. It's revived competition from the low-cost oil that's out there now. So rather than go all the way to LNG, with oil being that cheap, countries around the world are just going to use oil and not gas. So we don't think LNG is going to have a real impact here for the next 3, 4, 5 years, really. And it could be even a little bit longer than that. We don't see a lot of production growth, again, outside of the Marcellus and Utica. It's still going to be that associated gas. And so now as we just kind of sum up the talk and the gas part of it specifically, oversupply, mild winter, inventories are high. We think gas is going to be, sub $2, trying to get back to $3, as we've said. The price risk for gas is all downside. We think that these injection rates could set a record, as I said earlier. Beyond the near term, as far as markets are concerned, and with LNG lagging, Mexico could be a real benefit for gas producers. And Mexico has its own gas, but because they're tied to Henry Hub prices, they don't have the money to develop it. So they've built more infrastructure to bring U.S. gas down to Mexico. Now, most of that's going to come from Texas and Louisiana nearby. Don't know how much that's going to help the Rockies, but it is going to give gas producers an outlook. And then, as we just said, LNG is suffering from oversupply, and that's going to last for a while. So hopefully that gives you a shorter term picture of what's happening right now and when improvements are going to happen. And then again, Mr. Harris from Exxon is going to get up here right now and talk to you all about Exxon's view out much further into the future. So thanks again. Do we have time for questions, Kirby, or do we need to move on?
I think we have time for a few questions. We could either do it, you and Chad together, but I think I'd like to give people a chance right now first. Any questions for our
Any
keynote
questions?
speaker?
Did I bury you with statistics and charts? I hope not.
I guess we will go to questions after Mr.
I think this gentleman has one.
There we go. Mr. Finn.
Yes, I was curious. You said there is about 875 in storage right now.
We thought it could hit that, and now it's more like 821. It's still a robust figure, but it's not as bad as we thought.
How does that compare to a daily consumption? I mean, what time period does that consist of?
Well, that's the gas in storage over the 5-year average. So consumption
In excess of the 5-year average, or just
that's in excess of the 5-year average. So that's why that's such a big number. And then consumption is variable depending upon how cold it gets. That's why weather is such a big factor there. And I don't have the gas demand in my head. I think it's something like 67 BCF a day, maybe climbing up to 90 in the next 10 years or something like
so
that.
it would be a fairly long period of time that could be serviced from storage. Okay, I just kind of wanted to put that in perspective.
Exactly. Thank you. Thank you. Anybody else?
Another question?
Well, I see Mr. Harris at the back of the room already, and he's got his tie on and everything. So,
All right. Well,
Here
big
he
hand
goes.
for our speaker, Mr. Trammel.
thank you.
And thank you for coming.
Absolutely.